Yes, I mean, it's looking very much like this Goldilocks scenario is on track if you just look at that data. Stronger GDP, there's been strong retail sales and inflation continuing to fall. I think the thing that could complete that will be this week when we hear from the Fed and hear about what they're thinking on interest rate cuts. Because we think if you get a combination of strong growth, falling inflation, and rapid interest rate cuts from the Fed, then that's what it's going to take to move the market higher from here. So that kind of Goldilocks scenario, I think, will hinge on a lot of what the Fed says.
What I found interesting is that the market is still priced for about 50% chance of a cut come March. It does feel not that long away. I mean, we're only talking about 6 weeks or so until we get to March. The year is moving very quickly. What do you think would prompt the Fed to go for a cut? I mean, things have to deteriorate pretty rapidly in order for them to actually start with the cutting cycle in March, don't they?
Yeah, and I think that's why listening to Powell this week is going to be so important, because on the one hand, you can say, well, everything's humming along just fine, why change anything? Yeah. On the other hand, you can say that, well, look, inflation has now fallen back pretty close to the target, so is it time to refocus away from inflation and tackle some growth risks? And if you look at a state level, you are seeing unemployment pick up in a number of individual states, so the Fed might be wary of that and thinking about how they can shift away from inflation and towards stimulating growth again.
Do you think that the market expectation of how many cuts are going to transpire this year are actually going to be met between 4 and 5 interest rate cuts?
Yeah, pretty much. I mean, the market's pricing just over 5, but it's important to remember that that's probably a mixture of some people who are expecting maybe 3 or 4 in a kind of soft landing scenario, and some investors who are maybe pricing 6, 7, or even 8 in a hard landing scenario. So, we think that 4 is most likely. We're expecting a soft landing in our base case. So we think broadly that's going to be about the right level to help support the market further.
What do you make of the earnings season so far? I know there's a big week coming up. We've got a lot of the Magnificent Seven reporting. But then, of course, we had Tesla last week set the tone for many of the automakers. A bit of disappointment. Chip makers are going to be reporting this week. I know there's a lot of hype around AI, but not all of these chip makers are geared towards AI. Would you say that the bar is pretty high to beat at this point?
Well, yes, we've clearly seen a very sharp rally in technology companies, and we've seen some of the high-profile disappointments over the course of the past week. Our view is that overall the earnings season has been pretty good. We've had about 80% of companies beating by about 4 to 5% on average. So, we think that's consistent with high single-digit growth for the S&P 500 in terms of earnings through this year. And then on tech, obviously, we'll have to see with the Magnificent Seven, or many of them reporting this week. Nvidia doesn't come out until mid-February, so I think everyone's going to be trying to judge what some of the semiconductor results might mean for that, but we won't really find out for sure until mid-February.